Okay, we're back. We're live. This is ThinkTech Hawaii. I'm Jay Fidell. It's the 9 o'clock block on a given Monday morning. And we're talking about community matters today. More specifically, we're talking about David Whitcomb, a man to write about. Ooh, what does that mean? And our co-host is Ken Howe. He's a journalist. And we know Ken because he's a scriptwriter for one of our environmental movies. And we're so happy to know him. Welcome to the show, Ken. Welcome to the show, David.
Thank you. Thank you.
So Ken, can you introduce David? And mind you, we only have half an hour, so keep it, reasonable.
Well, I'll do the short version. This is David Whitcomb, professor, I guess retired professor, but he'll always be a professor in my mind. And he was also the founder of ATD, Automated Trading Desk. And what was remarkable about it is that's the pioneer behind high frequency trading. And although, to some extent, high frequency trading has gotten a bad rep from David Lewis's book, but the profound thing about what the professor did with his colleagues was to come up with a computerized way of trading. And at least in my mind, the way I see the legacy of that is it really cut into the pretty fat margins of the market makers and the hidden fees that they were charging. So he just sort of cut the knees off of that by using computers to trade in really very clever and interesting ways, including if we could get him to talk a little bit about, stock prediction on a micro level. But anyway, yeah. And at any rate, the book is a biography of a company, sort of how it was formed and the steps along the way, and frankly, the ups and downs, and then finally backups.
What is your approach in this book? Where do you come from and where do you go?
With the book itself, chronology is always one of the best ways to go. And that's the way we did it, since it is more or less a biography of a company. That was the approach we took. And then intersperse along the way some of the major concepts that are important to explain, and a little background on some of the major characters involved.
Well, it's always valuable to know, how somebody built a career, built a company, because we all want to do that, don't we? Mm-hmm. I want to do that, but I may not be able to do it at this point. David, can you just tell us a little about yourself from your point of view?
Yeah, I started out as a pure academic. So pure, I would have never dreamed of starting a company. I got my PhD in economics at Columbia, and my first teaching job was at NYU, your alma mater. Mm-hmm. And after 5 years, they concluded that I wasn't really very serious, since I traveled a lot, and I didn't publish enough to avoid perishing. So they didn't give me tenure. I went to City University 1 year, and then I settled at Rutgers across the river in New Jersey, but I didn't give up my low-cost NYU faculty housing in the Village. And early on, actually, while I was still at NYU, I got into a new field in financial economics called market microstructure, which is the study of the nitty-gritty of how stock markets actually work. Prior to this, economists had an idea, a theoretical model of stock markets developed in the mid to late 19th century. And no economist, it seems, had bothered to go anywhere near a stock market or a stock exchange in the interim. So we all thought stock markets, stock exchanges still worked the way they did in 1874. And my office happened to be next door to the American Stock Exchange, now defunct. And the guy I shared that small office with had a friend who was a specialist, and he said, let's go take a look. So he and I took a look. We were totally baffled by what was going on because it didn't seem anything like what our theoretical understanding of a stock market was like. So we began working in that field. It came to be called securities market microstructure. We even wrote a book published in 1986 with that title, sort of collecting some of our research and some of the other research that was being done. And then somewhere not too long after that book was published, I gave a lecture on stock markets around the world, and a guy who was the CEO of a company called Instanet happened to be at the lecture. He had built a trading system, an electronic trading system, not fully automated at all, but a system for institutions like pension funds and mutual funds to use. And he was getting some business because he was a darn good salesman and he had a great idea, but his system had to be operated by a trader for the institution who had to use a keyboard to enter prices, change orders. And for that reason, it wasn't very convenient to use. So he said to me, why don't you, as a consultant, come up with ways to get people to use Instanet more? And it occurred to me after a long night of listening to Bach and smoking Pacalolo that it would be good to develop, and it was possible to develop even with the primitive computers of the late 1980s, a fully automated trading system that a trader could use to do routine trades, easy trades. Let's say you want to buy 1,000 shares of IBM. It's a big liquid stock. It doesn't take a rocket scientist to buy 1,000 shares of IBM, but it takes a little bit of finesse to buy 1,000 or 10,000 shares of something without moving the market. And the idea was to do it as stealthily as you could so as to accumulate the position you wanted, but without showing your hand, because nobody trading in stock markets wants to show their hand. Instanet changed. The company was bought by Reuters, and this CEO retired, and the new CEO was a little less excited by my brilliant idea than the previous one was. And in fleshing out that idea, I also made the mistake of inadvertently hacking onto the Instanet system, onto an actual customer's account, without knowing what the heck I was doing. And just to see how the system worked, I sold several $1 million, quite a few $1 million worth of this company's stock around 3:30, just before the market closed, in a rising market. That was easy to do and very expensive to make up for the losses that I created. So needless to say, I didn't get any business from Instanet, and we didn't have a customer. So my kind wife devoted her entire salary to the support and feeding of Instanet's one full-time employee, not me. I was never a full-time employee, but one guy named Jonathan Butler, who wrote brilliant code. And we kept it alive for a while. Then I went to a bunch of fellow academic friends and raised some money from them. One couple literally kissed their check goodbye before they put it in the envelope and sealed it. And we raised a little pot of money to stay alive for another year or so. And then we got very lucky. One Wall Street guy who wasn't even a stock trader, he ran a commodities and currencies hedge fund. He said, here's 5 million, go play with it, go trade with it. Let's see if you can make money. Because I had written a simulation that said we could make oodles of money. Well, it turns out the simulation had one parameter wrong, meaning it inadvertently lied to me as well as to the guy who had put his money in. And after a while, although we built all of the structure to trade, we made money. We made gross revenues. But after paying commissions, we had negative net revenues. And naturally, that wasn't going to make this hedge fund guy wildly happy. So before he told me, I told him, I think I better give you your money back. As much of it is left. And, he lost 35, 40,000, wasn't a big deal. But it's interesting, the broker that we used as our link to the New York Stock Exchange, because we had to have a way to get orders generated from our computer onto the floor of the New York Stock Exchange. Morgan Stanley at that time had a very fast data link from their offices in New York to the stock exchange downtown. And they charged a 3 cent a share commission. We made a profit of about 2 3/4 cents a share gross for this guy. So with their 3 cent commission, he was losing money. But they scratched their head and they said, at our costs, we can make money. So they made a new deal with ATD, and we agreed to share all of the profit above a mythical 1 cent per share charge in lieu of commission. And we got 1/4 of it, and Morgan Stanley, who had the money, the stake, and the link to the stock exchange, got the other 3/4. And I thought then, and I think now, that was a very fair deal. So we limped along for 4 years, making nice, but still pretty modest profits, until another professor, unfortunately a very thin-skinned professor, came up with an idea that I immediately jumped on. He said, why doesn't ATD become the first automated SOES bandit? Now, Jay, I imagine you want to ask me what the hell is an automated SOES bandit.
Yes, I do, badly. Yes.
Yes, I thought so. We all understand automation, but SOES is the Nasdaq's was in 1990, the Nasdaq's small order execution system. It had been mandated by the SEC and the NASD after the mini stock market crash of 1987. And it required that any real customer, anybody trading on behalf of the ultimate customer, the small guy on Main Street, could buy or sell up to 1,000 shares of any Nasdaq stock just by getting his order to the Nasdaq market while the quote he was trying to, the bid or the offer he was trying to hit was still there. So it was a way you could be sure that the market maker wouldn't say, oh, gosh, you wanted to buy at 32 and a quarter. Sorry, I just moved my quote. Well, this kept them honest. And a so's bandit is anybody who takes advantage of that rule. That was the phrase made up by the market makers to try to make people like us look like bad guys. So picture me with a bandana over my mouth and a mask and a couple of guns, striding into a Nasdaq brokerage firm office and holding them up. That wasn't exactly what we did, but we made a pot of money doing it. And in the process, and I think this is a point that Ken will be making in the book from the drafts that I've seen, we began to put a lot of pressure on the basic design of the Nasdaq market and on the hidden commissions that Ken mentioned. When you trade, you have a very visible commission, whatever the broker charges you for the privilege of trading your account. That's the visible commission. Then there's an invisible commission, which is related to the bid-ask spread. There's always a spread between the highest price, the highest quote shown in the Nasdaq market or the NYSE, and the lowest selling price. The highest buying price is lower than the lowest selling price. And that difference is the spread, and the spread used to be 25 cents. Well, the market makers got caught with their pants down, so to speak, conspiring to keep the difference between bid and offer at 25 cents. The SEC and the Congress called them on that. They then changed the minimum increment that between price levels from, it was always 12.5 cents. And that goes back, as Ken's research shows, goes back to the most popular currency in 1792, when the New York Stock Exchange was founded under the buttonwood tree. That currency was the Spanish doubloon, and it could be cut into 8 pieces of 8. So each piece of 8 was 1/8 or 12.5 cents on the Spanish dollar. So that became the standard price increment in stock markets in the US. And the dealers and the stock exchange specialists loved that because it gave them a little built-in profit whenever they traded with somebody on Main Street. So we took great advantage of that because we could hit dealers before they could move their prices, and using the SO's small order execution system.
Very, very interesting. David, let's give Ken an opportunity to react. It strikes me, Ken, that there's a lot of material here. It's sophisticated. It's financial markets, it's technology, it's Gee, we haven't gotten to the end of it about how the internet has enhanced this whole operation, but you must be doing a lot of research and learning in order to write up what David is talking about.
I'm talking to the professor, so he explains it, and that's the most fun part. Is you like the spreads. It took me a long time to understand how are you making money on the spread, and if I oversimplify, the professor will excuse me, but basically, the spread is quoted at there's a price that someone's willing to sell at and the price somebody's willing to buy at. And the thing is, a market maker who's dealing in a particular stock can sell it at the high price, and buy it at the low price. So he gets to keep what's in between. And those spreads, even though it was 12.5 cents, in actual reality, most trades were done with a 25-cent spread, right, Professor? So that they're making bundles of money. So the key thing that, particularly early on, that ATD did was by computerizing the trading, they could act much more quickly than a human market maker could. So they could take advantage of trends that they saw. And besides trying to understand the spread, the most interesting things about what ATD did, in my mind, they did many, many things, but is using prediction models, trying to figure out where this stock might go in the very, very short term. And it was always, Dave had this great description of, a classical economic theory. It's a sin, basically, to pretend that you can tell where a stock is going to go at any one time, or where eventually. But it turns out on a very short period of time, there's this thing that is called drift, which essentially is kind of an inertia-like thing. The stock is going up over the next 5, maybe even 30 seconds. It's probably going to continue. But at the same time, they used all sorts of interesting data research to get a better idea of, well, which direction do you think it's going to go? I mean, it's not a mortal lock. But if you see the futures market is moving up, for example, or if you see a whole lot of orders piling up on the buy side, you might think, I think there's a better likelihood that it's going to go up than it is to go down. And so they had all these variables that they computerized to allow people to trade and spot trends faster than the market makers could. And that was what's so fascinating about it.
And we got to the point by about 2000, 2001, that we had the capability of predicting 30 seconds ahead, imperfectly, of course. It's a guess, but it's an educated guess, maybe 51% right, 49% wrong. Predicting 10,000 stocks 30 seconds ahead, 20 times a second. So every 20th of a second, we got a new prediction for up to 10,000 stocks. We never followed that many, but we followed 3,000 or 4,000 stocks, updating them in real time. And we began to trade real volume. At one point, we were accounting for about 6 or 7% of all the stock volume traded on both the New York Stock Exchange and the Nasdaq Stock Exchange. And that was with a team at that time of about 60 to 80 people, mostly programmers. Here you had a couple 100,000 people working on Wall Street doing the other 96% of the trade, 94% of the trading, and we're doing 6% with about 60 people and a lot of computers. That building you see in the photo behind me there was the ATD campus, the last gasp of our hubris, and it was filled with computers. It had 3 underground backup generators with enough diesel fuel to run the whole city of Mount Pleasant, South Carolina for 2 weeks. In fact, we became the place where the police, fire, and emergency rescue people would go in the event of a hurricane, because this building was also built to withstand an H bomb at anything but dead center.
So let me ask you some questions, David. So this the prediction thing really fascinates me, because when I think of prediction, I think of AI. And somewhere along the line, although you couldn't use AI, in the 80s, the 90s, or even the early 2000s, but at some point along the line, AI had to enter into this. Am I right?
Yeah, we tried to build a full-on AI model to do the prediction, and we never succeeded. That doesn't mean it can't be done. It will be done. It may be being done today by the successor firms, but what we had was what I would call a pretty well-educated expert system, as opposed to full AI. That is, we used the best of our knowledge. We used a lot of big data research. And this was pretty early in the life of big data type research. And we used it to build this prediction. And we collected each 20 times a second for each of 10,000 stocks. We had all this data, so we saved it and used it as a historical database for our research, and also released it to a number of professors for academic research.
That touches 2 points I wanted to get to. One
Yeah.
is, it's fascinating to examine the history of the computer in this country and of the stock markets in this country. Fascinating. And people do not realize, they don't have a clue how much has changed, even in the course of your lifetime and my lifetime and young Ken over here in our lifetimes. It has changed so dramatically. And to examine it is very, very important to understand it now. The other thing I wanted to ask you is, so you have this prediction system, which becomes more accurate as you refine it. Query, who gets the benefit of that? In other words, and maybe this is the model you're talking about evolving to today, is who gets the benefit? Is it the traders within ATD, or is it all traders who join ATD? Can a ordinary human being sign up and have the benefit of this predictive analysis?
Yeah, I can speak to that. A lot of the benefit actually didn't come to ATD in any form. I mean, we collected plenty. We did well. I'm very excited. And by the way, everybody we hired received bonuses, and fat bonuses. We tended to hire young kids in the summer between their junior and senior year at the College of Charleston. That is a small school, but it has a small, very good honors program. And my number two, who eventually replaced me as CEO, had gone there along with my number three. Both of them were graduates, and both knew how to select the really smart students. We would bring them in, train them not, they already knew how to write code, but we built a trading desk to do manual trading, same way they did it on the old Instinet screen, not for the purpose of making money, but for the purpose of letting these new hires understand the stock market. Some of them understood it so well that they made really big bucks for the company. One guy made so much for the company in his first year as a summer intern that we gave him a bonus big enough for him to buy a Porsche convertible. And that was pretty good in Charleston, South Carolina,
Really?
in the mid-90s. So the word got around. We didn't have too hard a time finding people, but we tended to hire mainly from that market because we could afford it, and we could also train them the way we thought it made sense. But you were referring to the benefit of all this stuff. One of the main effects that our kind of trading had on the market was it put pressure on the whole system to reduce those spreads. And not only was there economic pressure, there was also political pressure. Back in the days when the world, or when America actually had a bipartisan Congress, a Republican senator from Ohio and a Democratic congressman from Massachusetts got together, co-sponsored a bill called the Dollar and Cents Bill of 1997. And the impact of it was to force the spread, or rather force the minimum increment between prices to be dropped from 12.5 cents to a penny. After all, we use pennies, nickels, dimes, etc. for everything else in America. Why should we use Spanish doubloons to trade in the damn stock market? So I testified in favor of that before the Congress. I was the only CEO of a large brokerage firm to testify in favor of it. The other CEOs all trekked down to Washington and said, this is going to end capitalism as we know it. The US will immediately turn into a socialist, if not a communist country. And the world will end. We'll all be poor. We'll all be slaves to the commies. Don't do it. Well, fortunately, the Congress was going to do it anyway, and because they didn't believe that crap, and the exchanges decided to do it one step ahead of them. I had used my wonderful simulation model to predict that ATD would do very well, that the ultimate typical average spread would drop to about 2 or 3 cents a share. I was wrong, dead wrong. The spread dropped almost immediately to 1 penny. ATD lost bundles of money. And it took us about 3 years to dig ourselves out of that hole and start making big money again.
But it was a contribution to the community, wasn't it?
And that was the benefit to the community, because now that hidden transaction cost that people still don't realize they're paying went down from 12.5 cents, occasionally a quarter, down to a penny or two. So that's a big saving, which meant we couldn't keep all of that, but we kept more than we needed of the profits of computerized trading.
Yeah, you make it up in volume, right?
We make it up in volume, yes. As long as your net is positive, you can make it up in volume.
David, we're almost out of time, and I wanted to ask you one final question, and then go to summary, if I can warn you, Ken, with Ken. But David, what's the situation with ATD now? I heard you say that you stepped down as CEO. How big is it? What does it do? What is its role in the stock exchanges?
I can answer that very easily. A big zero. In 2007, we sold out for lots of money to Citigroup. Of course, they paid us mostly in stock, and their stock immediately tanked, but them's the breaks. And Citigroup ran it for several, I think for 9 years, deeper and deeper and deeper into the ground. And back in 2016, they sold it for pennies on the dollar of what they had paid us to a firm that's a competitor in the high frequency trading arena, a company called Citadel, based in Chicago. And Citadel promptly shut ATD down and fired all the remaining people. And this building is now, I think, medical offices or something.
Oh, no.
ATD does not exist.
How do you feel about that, David?
Obviously, I feel miserable about it. So, although, as Liberace once said about people who made nasty comments about his flashy outfits and his love of mama and his chandelier, I cried all the way to the bank.
Well, David, we don't have time to go into your various extra occupational activities. There are so many yachts and planes and space travel. And of course, your wife, Henrietta, and her art. And I would so much like to cover that. And I hope that you can come back, possibly the three of us, but also maybe Henrietta too, and talk about her art and all the things you do here in Hawaii and 6 months a year and in Manhattan and Massachusetts for that matter. We're about done, Ken. So I would ask you at this point to say what we take out of this. What to your understanding, what is the secret sauce?
I think it's a pioneer. It's a story about pioneers in finance, and it's a story about how computers really, as Dave said, just cut down those margins, the really fat cat margins that the market makers are making, and brought a little equity into the markets. And it's about, kind of the brilliance of many of the prediction models that they use to really compete with some of the bigger brokers. It's a fascinating story, and we haven't even gotten to his earliest venture in predicting horse races, which we'll have to save for another time.
We'll have to save it for another time. This is a great story. It's all great stories, and I'm so happy to have you on the show, David. I'm so appreciative, Ken, for your efforts in arranging this, and I sincerely hope we can do it again soon. Thank you so much, David. Thank you so much, Ken.
Thanks. Good luck.
Well,
Aloha.
pleasure.
Good questions.